Are live then. We're
Yes.
okay. Well, welcome, and I'm sure you found our little chatting here totally inspiring and breathtaking. Just a little bit of an update before we get started on today's discussion about economic and fiscal issues facing the president and vice president-elect. And indeed, we can use those terms officially now, since, as you know, the Electoral College did meet yesterday, and they voted as it was anticipated, given the votes of the people in the various states. So much more drama and much more attention paid to what is really just a ho-hum procedural kind of thing in our history. But there we are. When you get a president that continues to say that there's fraud, and actually the court cases didn't really allege much fraud at all. If anything, it was sort of alleging mistakes in the administration of the election. That was particularly true in Wisconsin, but that was true elsewhere too. They weren't saying that there were a lot of except for Giuliani, people weren't alleging that dead people were voting or people were voting multiple times and all that kind of thing. That's what we really mean by election fraud. In any case, we do have now officially a president-elect, and that, of course, is Joe Biden, and Kamala Harris, the vice president-elect. They have already begun putting together a cabinet, and they've been doing all of this with some Republican leaders saying, gee, I'm not so sure, or this is an election that was stolen by the Democrats, all those kinds of allegations. And also a lot of important key Republican leaders nationally and in states just not saying anything, and in a sense enabling Trump to continue his allegations. That has been particularly true in Wisconsin with Republican leadership here. This morning, Mitch McConnell, obviously key Republican and probably the top Republican official as we go into January, the majority leader of the United States Senate, has now publicly acknowledged that Joe Biden has been elected and even congratulated him. And there have been a number of others in the Republican leadership that have followed suit. There was some speculation, indeed, that the Republican leadership's reluctance to accept the election results would start to fade away after the Electoral College officially voted. So one would anticipate that there would be more of this, and that Trump would increasingly be isolated. And in fact, I know that there have been discussions among people in the media saying, maybe what we ought to do is just not even utter the words Donald Trump anymore for a while. There's other things going on, and he is really becoming increasingly either annoying or irrelevant. But that's probably not going to happen entirely. So that gives us a kind of update, and I might say, and I'm pretty excited about it, that one of our sessions for next month is going to be the future of the Republican Party, and our presenter or key discussant for that is Professor Ryan Owens, who is he's the director of the Tommy Thompson Center at the University of Wisconsin-Madison, and has been a major figure in the political and intelligentsia of the Republican Party among their leadership, working with Scott Walker and with other Republicans. So he's, in a sense, a real insider. And he's also he is, I think, a very good analyst. And he has indicated to me that before we have our discussion with him in January, he'll send out, in a sense, a little bit of homework by way of some videos or probably some short articles that talk about the different kinds of conservative thought within the Republican Party. So he will, on the day before inauguration, lead us in a nice discussion about the future of the Republican Party. So,
Dennis, a couple of questions. People want to know what you think, first of all, about Barr quitting just before Christmas. He could have stayed on another, few weeks. Is there something going on with him trying to launder himself, or is there something else coming from Trump he wants to distance himself from because it's going to be too outrageous even for Trump, even for Barr?
Well, I think those two speculations about the reasons why Barr and Trump have announced Barr's leaving the administration, I think they go hand in hand. That is to say that particularly the way that Barr was not as tried and true a loyalist as Trump would have liked in challenging the election results, made that statement, as you may recall, that he didn't see any election fraud and that the Department of Justice had finished its investigation. And Barr had a reputation before joining Trump that was one that was pretty decent in terms of his professional characteristics and demeanor and qualifications. That, in the minds of many people, has been sullied by him transferring or translating the role of Attorney General from being an independent Justice Department to being Trump's lawyer. And Trump has always insisted that the Justice Department and the Attorney General be acting like his personal lawyer. I think Barr would like to get a little bit back the reputation that he had before he associated himself so closely with Trump.
On yesterday's Supreme Court ruling, do you think that the three judges really believed that many votes should be thrown out, or was it just a protest vote to the majority? And in fact, it was not unanimous, 9-0.
Well, that's a good question. And I wish I could get inside the minds. Well, maybe not. I was going to say, I wish I could get in the minds of the justices who voted in the minority in this particular case. I think that Hagedorn, in his majority opinion, was taking the safest view. If you're a strident Republican and you're presented with the kinds of issues that that case presented, I think Hagedorn took the safest view of this and saying, look, if you have problems with the way you thought that the rules of the game were established for people to vote in Wisconsin, you should raise that before people start voting, not after they vote. And that, I think, is both a legal doctrine and legal basis, as well as common sense basis. So the others, yeah, they're very closely tied to the Republican Party. Some of them are much more ideologues than others. It's been quite a show, and it's I think it's fair to say that it is good that the majority opinion was the way it was, both for Wisconsin as well as the electoral process generally.
What would have happened, Dennis, had it been the other way? Would we have not been the vote was supposed to happen, the Electoral College vote was supposed to happen within the hour. What would have happened?
Well, good question. We've never faced that before, so we don't know if the electors would have gone ahead and it would have been a case before the U.S. Supreme Court, in which on the one hand, you've got the state Supreme Court saying, well, there are problems with the election and we ought to toss out votes. And yet, remember now, if they were going to toss out that many votes, the choices, because it's a secret ballot. So the choices are either throw out all the votes from Dane County and Milwaukee, or if you're going to throw out less than the total number of votes cast in those two counties, you take the number and you randomly delete votes. And a random process for taking away votes doesn't make a whole lot of common sense either. So it would have been a real mess within the state. And I think that the U.S. Supreme Court would have been presented with the dilemma of, well, what do you do when there's a dispute within the state and a situation where the electors have been certified in accordance with Wisconsin state law, which is the prevailing law here, not federal law, and we go ahead and ignore the state Supreme Court. The state Supreme Court has been the state Supreme Court has been kind of cast aside in previous situations. The Florida situation in 2000 is a case in point, where the U.S. Supreme Court basically said, well, the state Supreme Court's got it wrong in interpreting their laws, and so we're going to order that. In that case, Bush is the winner.
So we know, and people want to know your comments and thought on this about what can happen between now and January 6th. We know that several states, including Wisconsin, where the Republicans had their own electoral slate ready to go and are going to send these, Michigan for sure, I know, send these to Congress. Now, they will go without a Secretary of State seal on them. But what is it? What are the, can you walk through for a few minutes before we get to Kurt, a couple of the options of what could happen between now and January 6th?
One very likely outcome is that all of that will be just ignored. But if it's not ignored and treated seriously, and that would happen if there is at least one member of the House of Representatives and at least one member of the Senate. Doesn't make any difference what party, but presumably we're talking about Republicans in this case. And the speculation along this scenario is that the most likely U.S. senator to participate in this kind of a process would be Wisconsin's Ron Johnson. So you get a member of the House and a member of the Senate who object to the votes that were cast from in the Electoral College as a whole, and say that there were problems with particular states, and they identify the states. Then the issue gets resolved by a majority vote. When you take in a majority vote in a joint session, so you have the senators and the members of the House of Representatives meet together, and these would be the ones who were just put in office after the November elections, because that would happen a couple days before they would do this in the Senate and in the House. So it would be the newly elected senators, the newly elected House of Representatives, and a majority would have to vote to cast it out or try and determine themselves who should be president and who should be vice president. It's not likely. It's really not likely that we're going to see that whole scenario play out. But it would be a mess, and it would be the first time in U.S. history we've had that kind of a mess. We've had other electoral messes earlier in our history, but not like this one.
Well, and so if you actually had 2 or 3 Republican senators step up right now, Romney or somebody else, what's her name from Maine, somebody step up and just say, we're not going to consider this, it would all be done. They could just, all this talking could be done if you get 2, maybe 3, but for sure 2 Republican senators just say, no, this isn't going to happen. Then besides ignoring it, you would also have certainty that there never could be a majority vote there.
Yeah, that's true. Although the other possibility, if it's everybody's going to vote along party lines, is that since it's a joint session, you have all of the members of the House and the Senate together. The margin of the majority of Democrats in the House would be enough to nullify any effects of Republicans all voting together in the Senate.
Oh, okay. I lost that. Okay. And let's see, there might be one more here. Let me look real quick. Yes, wouldn't it all, back on the Supreme Court, wouldn't all local races have to be thrown out? Because that's what happened in the other 70 counties if they had gone the other way.
Well, that's a good question, and it was not really raised and therefore not answered. But yeah, since we're talking about it is conceivable that the remedy because the remedy that was being sought here was to throw out the presidential results, not nullify the elections as a whole, not the down ballot as it's often referred to. And one of the Hagedorn's points was, holy cow, I mean, the remedy that you're talking about here is totally unreasonable. And it would probably be regarded as even more unreasonable if you did all of the contests throughout the entire ballot that took place, which is not to say that it wouldn't happen, but that is a possibility, but it would have really done something for the justices that is pretty unusual in any kind of a court case, and that is you go beyond the issues that were raised and bring along some other things too.
So last one before Kurt. So Hillary, casting her vote, asked for the abolishment of the Electoral College. You see anything happening with that in the next 4 years?
No, the Electoral College works too much to the advantage of the smaller states, smaller in terms of population, and you would need too many of them to sign on to abandon the Electoral College. I think the more likely situation would be that we have this compact among the states that the states that join the compact would cast their votes for whoever won the national popular vote. They would get the Electoral College votes of that particular state. If you got enough states to do that, then you effectively would abolish the Electoral College. But to change the Constitution runs against the really self-interest of the more rural-based states.
Yeah. Okay, well, thanks. So Dennis, and thanks to everybody. We're up to about 88 people, which is amazing since this is the extra credit Plato. Thanks for all of you guys being willing to, the ones who answered our survey and then saying, yeah, there's still stuff going on as long as COVID and we have nothing better to do. Let's listen to Dries for a minute. But you guys gave us some topics and we proposed some, and we're going to kick that off now with this first Plato extra credit. Dennis and Kurt Sippel and I have been sort of the leaders on this for a bit, but Kurt, one of the topics that came up was about what is happening with the economy and what issues will be facing Biden. And Kurt, don't know if we've ever introduced totally on him, but he started out graduate at UW-Madison, but he's a researcher for Don Nichols, one of the top economists at UW-Madison and at the La Follette School, where Dennis, Kurt, and I all were at one point. And he left the La Follette School to start his own tech company, Applied Tech, which is now the Dane County's largest managed services provider. And after he founded it in the middle of the Depression and back in 2000, and so he ran it for 20 years and just sold it. He's still a stockholder, but just sold it just in the last year. And he's now basically a venture capitalist and an angel investor, and does a lot of mentoring for other people with their businesses. And he is going to talk to us today about monetary policy, fiscal policy, and some of the things that we're facing here, and sort of give us a backstory to some of this, because all of these terminologies, vocabulary, are things that are now clearly in front of us at all times. And I'll tell you that Kurt makes no bones about it. He's more used to speaking to a boardroom than a classroom. So we'll cut him a little slack on that. I hope you will. So Kurt, take it away.
You make me sound smart, Terry. All right.
All right, live up to it. Live up to it.
I'll work on it. All right. Let me just get this set up real quick.
We can see your screen, so you shared it.
Awesome. All right. Cool. Yeah. So Terry's right. I worked with both these guys. They had to suffer through me for about 8 years before I went off and started a company. And one of my best days, or one of the days I was getting ready to leave, Don Nichols said, "Why are you doing this? The bottom's going to drop out of IT." And he was right. It did, but I was just getting started. So that actually worked in my favor. So I'm hoping, or so the first thing is, Chinese curse, may you live in interesting times. We certainly do. And I'm going to use this only once, but the obligatory term unprecedented. So what I'm going to hopefully talk about today, bit about the economy, specifically labor economics. It's what I used to do in a previous life for Don Nichols. What the government's response has been to the pandemic so far. A little bit about macroeconomics, particularly monetary policy. Review what the Federal Reserve does versus the Treasury. The differences between monetary and fiscal policy. Most of you may already know that, but I want to hit it real quick. And a bit about quantitative easing, which everybody hears, but what is it and how's it work, and what the results have been so far, and then start a discussion about what might come next. My goal is to give you some tools and ways to think about this, because this is going to be a long time coming yet, and also since we're stuck inside during the winter, to hopefully entertain you a little bit and provoke some useful thoughts. Be patient. I don't speak for a living, but I certainly know the tech, and I know the economic stuff quite well, and also trying a few new things. So be patient. Also, hopefully none of you are economists. I'm kind of hoping. So the first thing I'm going to do is focus, as I mentioned, on labor economics. This is not a pretty put together graph, but it is the number of months. And I used to do this stuff for Don Nichols. It was a little bit of a dark art when I did it a number of years back. But if one of the mentors that I had when I was in business referred to this as gaining speed and losing altitude. If you want, by the way, I can put together a broader report on different on some of the other economic indicators, but it's important to note, though, that these are job recoveries, not job fill. We have a 10 million hole to fill, so I'm thinking we're probably going to go back into actually shedding jobs in another month or two. And at the current rate, they said it would take us 10 years to recover all the jobs that were lost. By the way, questions are welcome as I go along here. So current unemployment rate is at 6.7%. Looks like about where it was in 2013. But that's only part of the story. And by the way, my data is coming from Fred, or the Federal Reserve Board in St. Louis. So you can just go out there and grab some of this data if you want to look at it. So the biggest thing is labor force participation. 400,000 people stopped looking for work last month. And that's dominated by women and people in the lower that are paid less. Think restaurant workers, cooks, domestic workers. So real unemployment rate is thought to be more around 12.1%. So just another look at that. African American unemployment rate is 11.2%. Women is 6.4%. Contrast that to white men over 20 is 5.9. And then I'm going to try to do a live graph here that I think is useful. Works. So a V-shaped recovery, but if you go back and actually show what happened in 2008, I'm just going to go back to that. 2008 is barely a blip compared to what we did. So those are initial jobless claims.
That's jobless. Okay. Okay. Wow.
Initial jobless claims. Yep.
Jesus.
Yep. So 2009 was the height of it at 680,000 people that filed at the beginning. That was the worst month. Last month we had 716,000.
Wow.
So the other thing to look at, or we used to look at a fair bit, was consumer sentiment, right? It's recovering, as you can see, but it's not. So the reason I'm looking at this is roughly 70% of our GDP is consumption. And it's going to take us a long time to get back to where people feel comfortable in the economy again. It's also referred to in economic terms called the paradox of thrift. If people believe there's going to be a downturn coming, they save, not spend, and it's kind of self-fulfilling. There's a Forbes study that was just completed and said half of American workers say that they or somebody they know are going to lose their jobs in the next 6 months. So I grabbed this. It's a little dated, but Yelp and a UC Santa Cruz survey say between 800 and 1,500 jobs are closing per day right now. The Fed estimates 5 to 7% of businesses will close permanently. So you're seeing this is permanent closures going up significantly. So what has our economic response been so far? This is just a graph basically explaining we've almost 2.6 trillion have been appropriated. Put that into context, the entire US budget for 2020 was 4.8 trillion. So as we add the next stimulus bill, which is most certainly we're going to have some point here, we're going to be that double again as much as our current fiscal budget is. So contrast that with 2008, we were 940 billion, so just under a trillion, and that was 152 billion in 2008, and 2009 and beyond is about 787 billion. So significantly more. Get to my concerns about that in a minute. So a little visualization of that. The CARES Act has spent 2.3 trillion so far. I like this graph, because it does a nice source and use of the monies and where they came from and where they went. There's a lot to digest.
And Kurt, isn't one of your things that keep you up at night besides inflation, on the source, that those loans will end up being?
Yep. This forgivable loans, and I suspect a lot more will be not paid back. An example of that is I'm on a board for a nonprofit, and they were able to take out a loan, and they've got no hope of paying that back. But they'll spend the money. I promise you, they'll spend the money.
And so, Kurt, so when that money is no longer a loan, but is a grant, then that loan then adds to our debt.
Yep, our deficit. Yep.
Our deficit, yeah.
Yep, deficit debt. So what I should have learned of monetary policy if I'd been paying attention, and quite frankly, if the prof was any good at the time, was a brand new prof. He didn't stay at the EW very long. Matter of fact, I think he was done after a semester. So this is called the quantitative theory, or quantity theory of money. It's quantity of money times the velocity equals price times gross domestic product. And simple, right? So now that y'all know that, great. But I'm going to take a deeper dive into this, and I'm going to attempt something. I'm going to try to redirect some audio of a couple of videos that I've got that are short. I've clipped them down. Hopefully they're useful. And if you want them afterwards, there's more to each one of them. But if it works, we should be in good shape.
Today we're going to introduce an important tool for thinking about issues in macroeconomics, the quantity theory of money. Let's imagine the journey a dollar bill might take in a year. Imagine that the dollar bill starts with Tyler, who buys a pupusa from Don, the street vendor. Don gives it to his daughter, who spends it on a pony ride at the fair. It ends up in the hands of Alex, who after losing it, and then finding it in his couch cushions, buys a cup of coffee while on a road trip to see his favorite polka band. So in a year, this dollar has been spent 3 times. On the pupusa, the pony ride, and on a cup of coffee. Okay, we've got the building blocks to understand the quantity theory of money already. Our dollar bill, well, that's money, which we represent with the letter M. How many times that dollar gets used in a year is called the velocity of money, which we'll label with a V. In this case, V is 3, as our bill was spent 3 times in a year. The pupusa, pony ride, and coffee are real goods and services, which we'll call Y. And the price of those goods and services we'll call P. These are the variables in the quantity theory of money. Now, let's think about this for an economy as a whole. M would be the money supply, all the money in the economy. V would be how many times a dollar is spent purchasing finished goods and services. Some people hoard cash under their mattress, so their dollars have a low velocity, while others spend or invest their money quickly, and their dollars have a high velocity. V is the number of times the average dollar is spent. P would be the price level of all finished goods and services in an economy, and Y would be all the finished goods and services sold in an economy. So Y is real GDP, and when you multiply it by a measure of the price level, you get nominal GDP. Same thing over here. You take all our money, M, and multiply it by how many times the average dollar was spent, or V, and you get nominal GDP as well. Both sides represent nominal GDP in a different way. So, these are equal by definition, which is why we call this equation an identity. One way to think about it is that how much money we have in total times how many times the money is spent covers the actions of buyers. The stuff we sell times the prices we charge covers the actions of sellers. Given that everything that is sold is, by definition, bought by someone, this equation is true by definition. There are important questions about the variables and how they are measured. How do we measure M, for example? However, the core identity that M times V must equal P times Y gives us a lot of insight and a way of organizing our thought about important macroeconomic issues. So, we'll return to this tool often. For example, what can this identity equation tell us about the causes of inflation?
That work okay, guys? You were able to see it?
Yes, I think it worked really well, Kurt.
Okay. So causes for inflation, I mean, again, I was looking at this early on when we put all this money into the market, and I'll hit this a little deeper later, but I want to this will explain how inflation works and where it comes from. And it's another short chunk of a video.
And this is the thing that keeps you up, really wondering about money supply and what we're going to face down the road.
Yes. Yeah.
It's not being talked about much.
Nope, it is not. Well, and by the way, I'm not saying that this shouldn't happen. But we have to prop up our economy. But this is more longer term.
Today, we're going to explain the primary cause of inflation. And we're going to do so using the quantity theory of money. Let's start by rewriting our equation slightly. We'll divide both sides by y, so we get this. What this equation tells us is that if prices are changing, there are 3 possible causes: changes in M, V, or Y. Now remember that P, prices, they can change quite a bit in a short period of time. There are many times and places, for example, when prices have doubled or tripled in a year. On the other hand, V and Y are pretty stable. Consider Y, that's real GDP. Real GDP, it doesn't vary that much within a year. An increase of 10% in a single year, that would be astonishing growth. And a fall of 10%, that would be a very unusual Great Depression. So changes in real GDP, they don't seem like a plausible candidate for explaining large and sustained changes in prices. What about V, the velocity of money? The velocity of money is the average number of times that a dollar is used to purchase final goods and services in a year. In the US economy in recent years, V, it's been about 7. And it's determined by the same kinds of factors that might determine your personal V. Factors like whether you're paid weekly or bi-weekly, or how long it takes to clear a check. As we'll discuss later, V can change in the short run, but it might go up to 8 or down to 6. Usually not much more than that. So again, V doesn't seem like it can change enough to explain large and sustained changes in prices. So if Y and V are relatively stable, which we'll note by adding a bar over top, then it follows immediately that the only thing that can cause an increase in P is an increase in M. In other words, increases in prices are caused by increases in the money supply. It's changes in the money supply that are driving the speed and the height of our inflation elevator. We can summarize this by writing the quantity theory of money in a nutshell. Here's our equation written in the earlier form. Now what this equation says is very simple and intuitive. When more money chases the same amount of goods and services, prices must rise.
So 2 more pieces to that is there's something called modern monetary theory, which says since we're the world's reserve currency, we can just print as much money as we want, or effectively change the numbers at the Fed, and there's going to be demand for it. I don't subscribe to that, neither do Janet Yellen or Jerome Powell. So then I just going to take a step back, just explain because what the Fed does versus what the Treasury does, and then fiscal versus monetary policy, just real briefly, so everybody kind of understands it and has the same tool set. Part of why I'm doing this is so that when we hit some of the later graphs and stuff, it actually makes some sense to you. So the Treasury is headed by a presidential appointee, and currently the Treasury Secretary is Stephen Mnuchin, soon to be Janet Yellen. I'm a big fan of hers. Hopefully you guys enjoyed the little video that I had sent out about her. She is exceedingly qualified. So the Treasury Secretary advises the president on a bunch of policy, basically trade, taxation, and borrowing and lending policy, and then also oversees the printing of currency and actually enforces forgery using the Secret Service, and then also advises on sanctions for countries like Iran, for example. Fiscal policy is fairly straightforward. It's controlled by Congress and sometimes the White House. Think tax and spend, right? And they balance the checkbook by having the Treasury print and issue bonds. So, the Federal Reserve. A reserve is, think of them as America's checkbook. They lend money and they control interest rates, and headed by Jerome Powell, formerly Janet Yellen, and before that Ben Bernanke. Goal is to maintain a low unemployment rate and balanced with stable prices. And they're also often referred to as the lender of last resort. So I'll hit a little bit about that. So monetary policy, the primary tool is the Fed's overnight rate, which has been really, really low. So that hasn't been real effective. So that's where quantitative easing comes in. We'll hit that in a minute. And then they also control how much reserve currency a bank has to hold. After 2008, again, started quantitative easing. Expansionary policy is kind of what we're doing right now. We're putting a lot of money in the market to prop it up. Contractionary is just the opposite. When the Fed thinks that inflation's getting too hot, they increase interest rates or increase the prime rate, or actually reserve rate, and that kind of trickles through the rest of it. And I'll hit that a little deeper as well. A friend of mine refers to it as the Fed takes the punch bowl away right when the party starts getting good. So just to recap, the fiscal policy is controlled by Congress and to some degree the president. It's definitely much more much more political. In theory, monetary policy set by seven governors who are appointed and headed by the chair, and it should be independent in theory. So
Kurt,
yeah.
Somebody says they're a newbie in this area. So is the national debt backed up by real money, or is we just print money with nothing backing it up? Are we borrowing from ourselves? Is it fake? What is it?
We issue treasury bills.
Okay, and people buy those.
And other countries even buy those. Yeah. Yes.
And that's what backs up our debt.
Yep. In a nutshell. And again, that's partly why I'm doing this, to give people kind of a quick background of it. Okay. I can send the videos out actually, and they're longer and they give you much more detail, but it was too much for people to consume.
And you, Kurt, some of these sources you have, like Committee for Responsible Government and the FRED, these are sources you think are good and safe and on target.
Yes. Yeah. There's one that I'm using called the Marginal University. I can't remember what it exactly is, but it's a series of them, and it's one of the ones that I just used now, or two, might even be both of them.
So people can trust those. Yeah,
they're quite good.
And Kurt, just to elaborate a little bit on the idea of when we are in debt and sell bonds to other countries. For example, China, doesn't that give them a great deal of leverage over our economy?
It does, actually. One of my concerns.
Okay.
So I got a couple more short videos on what quantitative easing is, so people understand it a little bit. One thing to note is quantitative easing, there's a lot of controversy around it. Japan started it in 2001. We've only been doing it since 2008. And the main reason we're using it is it allows us to control different segments of rates rather than just the overnight rate. And so we can target stuff a little better. And quite frankly, our interest rates have been so low that dropping the overnight rate is by a little bit doesn't really affect or stimulate our economy much. So hopefully this works as well.
In March 2020, the Federal Reserve, or Fed, cut its target interest rate to 0 in response to the economic slowdown caused by the COVID-19 pandemic. This led some to wonder if the Fed was all out of ammo in its attempt to spark economic growth. But when faced with an economic crisis, the Fed has many tools at its disposal to boost economic activity and keep the money flowing. One of those tools is called quantitative easing, or QE. QE is a tool used by central banks to provide liquidity and keep money moving through the economy. In the United States, the Fed has typically done this by purchasing securities like longer-term treasuries and mortgage-backed securities on the open market. The intent is to keep rates lower and help lenders find investors. So how is QE different from the Fed's usual tools? The Fed is charged with managing the U.S. monetary policy, which means changing the money supply in an attempt to manage economic growth and inflation. The Fed typically does this using the federal funds rate, which is a very short-term interest rate that helps determine borrowing costs for banks. The Fed sets a lower target for the short-term rates through a process called open market operations. It essentially creates or quote-unquote prints money by buying very short-term treasuries, which pushes the rate lower. Normally, that lower short-term rate can lower interest rates across the board. This makes borrowing for people and businesses cheaper, ideally boosting the economy. But during a financial crisis, Economic worries may hamper the trading and lending that lowers the longer-term rates. When this happens, the Fed may engage in QE. It does this by buying other assets like longer-term treasuries, mortgage-backed securities, or commercial debt. Buying these assets can pull the yield lower in targeted areas. The goal is to find places where money isn't flowing and remove the logjam. The Fed used several rounds of QE to help the economy recover from the financial crisis of 2008, buying billions in treasuries and mortgage-backed securities between 2008 and 2014. In response to the COVID-19 crisis in 2020, the Fed again instituted QE. This time, it announced essentially unlimited QE, assuring investors it would continue to help the economy as long as it was needed. The Fed also expanded the program to include buying corporate bonds and bond funds. In addition to QE, the Fed also responded to the coronavirus by reinstating 2008 crisis measures like lending programs for banks, large corporations, and foreign central banks. It also loosened some financial regulations introduced after the 2008 financial crisis and introduced new lending programs for small and medium-sized businesses and state and local governments. So, the Fed is clearly not out of ammo when it cuts the federal funds rate to zero. However, printing all this money may come at a cost. The US dollar, like any asset, can fall in value if there's an enormous increase in supply. Some economists fear that QE could result in hyperinflation or a fast rise in the costs of goods and services. Since the 2000s, broad inflation has been kept in check by free trade, globalization, and higher productivity, which lowered the costs of many goods and raw materials. However, prices of assets like stocks, bonds, and housing have seen tremendous inflation. Additionally, purchases that often require loans, such as college, housing, and cars, have seen a dramatic rise in prices. While there are numerous factors that can impact the prices of goods and services, some economists point to Fed policies as a cause. Along with inflation, some economists have argued that the increased money supply and the low cost of borrowing could result in a debt trap, where servicing the rising debt levels may make it harder for businesses and individuals to spend and invest in ways that lead to economic growth. Finally, other economists argue that inflated asset prices caused by QE primarily benefit the wealthy rather than supporting broader economic growth driven by middle-class consumption.
So that is again a clip of a piece. Actually, it was done by TD Ameritrade. I actually just liked it. It's a little bit of a commercial alongside it, and I clipped that piece of it off. But I really like the graphics, and I don't have the ability to do that. I'm not that good at it. A couple of things that are useful to note, though, is they referred to corporate bonds. So in this go round in 2008, they talked about doing buying corporate debt, but they didn't do it. In this go round, they basically pulled out all the stops. The next, I've got one other little video, and then I'm going to hit some of what I see happening after that. But this one again is by that marginal Revolution University. I couldn't remember the name of it, and that's actually really well done as well. And it goes a little deeper on this, and it's fairly short. It's going to be about a minute and a half or so.
So Kurt,
yeah,
and I don't know if this comes up now or later, but a couple of terms that I hear often are things like shadow banking, and I hear liquidity traps. So are they related to any of this stuff at all?
Yes. So I was going to hit shadow banking, and it just got it was too broad. Right now, we're borrowing more money outside of the banking system. Think mortgage brokers and there's a lot less regulation. There's been some put in place after 2008, but the Fed has really limited control on what you can do outside of that.
And a liquidity trap, what is that?
So liquidity trap, your whole the Fed's whole, well, this actually, you know what, that actually is hit in this next video.
Okay,
So,
I'll hold off. There's one more, but I'll hold off.
yeah.
Quantitative easing, acquired the ability to pay interest on reserves and began conducting repurchase and reverse repurchase agreements. Now, those are big terms, new concepts. We're going to go through them one by one, but overall, those were ways of influencing the economy during and after the Great Recession. First, to stimulate the economy following the crash of 2008, the Fed conducted a kind of quantitative easing. That term can be used in somewhat different ways, but often it means that the Fed swaps money for assets other than T-bills. Recall now that T-bills are the shortest term and most liquid of government securities. By choosing additional types of assets to purchase and not just T-bills, well, that allows the Fed to affect different interest rates, longer-term interest rates, and to target particular parts of the economy. For instance, the Fed may target mortgage securities or other assets with longer maturities than T-bills, and again, that helps the Fed lower longer-term interest rates rather than just shorter-term rates. In addition, by purchasing, say, mortgage securities, the Fed can help to ensure that lower interest rates also translate into lower mortgage interest rates, and that will help out home buyers and, one hopes, spur the purchase and creation of new homes. Quantitative easing also increases the bank's supply of reserves and thus liquidity. Since 2008, excess reserves in banks have increased from about $2 billion to $2.7 trillion. Changing.
Wow. Wow.
So hopefully that helped explain this a little bit better. So as I mentioned, the federal funds rate was starting to get a little bit. The economy was doing pretty well in 2019. It was starting to come back, so they were starting to raise the overnight rate or federal funds rate, and cut them very quickly in March, and then later March, when it was apparent how deep this was going to go, they really cut it. They cut it to zero. And they also reduced what the banks have to hold in reserve from 10% to zero. So they moved very, very quickly.
Wow.
And again, remember the equation that I used before. So here's what actually happened. So first of all, I guess I got to take a quick lesson on money is not money. Everything is more complicated than it sounds. So I basically there's M1, there's actually an M0 and an M4 as well, but M1 is the narrowest definition of money. It's basically cash, what people have in cash and their savings account. And then M2 is typically used because that's things that can be quickly converted to money. It's basic. In a nutshell, it's any savings account less than 100,000. So that's the one we're going to pay attention to. And then this one is institutional money, as it says. So I'm looking at M2, the money stock, and versus GDP. So I was always taught that if you increase the money supply at the same rate that the gross domestic product increases, that keeps interest rate or inflation in check. It keeps it pretty even. But obviously, we have a quick turn here. And actually, I'm going to try to go to a live graph again and see if that works. So.
And you're saying this is live? I mean, like right now?
Yeah, this is from this is from
St. Louis.
Yep, this is from St. Louis. So the interesting thing, if I can hit this, yep. So we were at about 15.5 trillion, call it, and all of a sudden we're at 19 trillion. And if you look at 2008, it's barely a blip. So core inflation rate should be going up, but it's not. So given what we just learned, right? An increase in GDP, and it also talked about so the way to keep it in check is an increase in GDP, increase in imports it talked about, and that's accurate. So the theory is that the goods that we import, there's basically more supply, so it keeps the price lower.
And
The
your
other-
concern is that this is going to go off the chart. At some point, it's got to catch up with us.
It's got it by definition, it should, yes. Now the Fed can pull cash back as well, because they can basically buy bonds back and reduce the supply, but some of this is just out in the market. This is the first time that we put cash out and give it to individuals to spend as opposed to lending it out. So in 2008, we did more lending than anything else. So the other one that I have not really seen any place, but I've read a little bit about, is wealth concentration keeps it in check. So the cash ends up in wealthier folks' pockets, and they basically hold on to it and don't spend it.
So let me ask you on that.
Yep.
It's hard for me to believe that a dollar bill that I spend is only transferred 7 times in a year. I mean, the guy finding it under his couch is sort of goofy.
Yeah.
So
yeah.
seven times in a year. So I buy a 12-pack of beer from the liquor store, and now the liquor store guy who owns it, he's got to pay his employee.
Yep.
With that. I mean, how can it only be 7 times in a year?
I don't know.
Well, I mean, it does seem to me that if you get to a point, let's say it's a guy who owns 10 liquor stores and then invests in the market, and it sits there. And so it does seem, if the only way I could come up with that being 7 is that
Wealth
it gets to the rich people, it gets to a rich person who doesn't need to spend it.
It
seems like all the money goes up to the rich people. I mean, I don't know how else can it only be 7 times?
That's my argument.
At some point, Pick and Save.
Yeah.
The guy who owns Pick and Save, is buying a house in Hawaii or something, and then that money just quits. Is that how to think about it?
That's what I see happening. Yes.
Okay.
So this right now is keeping this in a nutshell is keeping inflation in check. So the velocity of money has just dropped off significantly.
Huh. Okay. All right.
And personal disposable income, it's kind of weird, but because of the $1,200 stimulus and the additional $600 a week for unemployment, that's actually we've actually increased our personal disposable income over this time significantly. And this is people starting to use that cash as they need it. So this is again upper middle class and wealthy holding on to the cash. Again, talking about that paradox of thrift. So what's likely to be the response going forward? Well, that's a doggone good question. So first of all, the things that I know are expiring, the extended or expanded UC benefits that the Fed's doing, they actually end on the 26th of December. Merry Christmas. Contractors and gig workers, they've been paid by the federal government because they aren't usually covered by unemployment comp. That's ending the 26th. The student loan forbearance program's ending. And I had these just in my notes, but eviction moratorium at the end of the year. And the student loan one was just extended to January 30th. And then the Social Security deferment is ending the 31st. So that's an interesting one as well that I've not heard much about in the news, but most it comes due, right? It's just there's 6.9%, I think it is, or call it 7%. That's withheld from everybody's paycheck, and the company pays in just as much, or an equal amount. That has not been withheld, or you had the option of not withholding that. And the two biggest employers in the country have actually elected to do. In the private sector, like my old company, we elected to continue to draw it out of people's paychecks. But it comes due, and the two things that haven't is the federal government and the military, which is about 3 million employees.
So, Kurt, you have a question here, is that this doomsday thing you're showing and everything else you've shown, what the hell's up with the stock market?
Yeah, so again, we're propping up the stock market by putting as much cash in. And I think that's what's happening, is we're actually seeing inflation getting baked into the stock market. That's what I'm seeing going on.
And that means what?
So the stock market actually, oh boy, I look at price per earnings of shares, and it's higher than it's been, and actually earnings for companies has been declining and declining some. So I think what you're seeing is the one of those numbers, which is the price, the price is eventually that number's got to increase because of inflation.
Wow.
So estimated 4 million people are going to face eviction at the end of this. At the end of the year here, 17 million are behind on their rent or mortgage. So then I wanted to just take another step back. So there is some good stuff in here, some good news. I think Janet Yellen's going to be exceedingly good in that role. Hopefully you guys, again, enjoyed that video or got something out of it. And she's a huge Keynesian proponent, right? So she believes, Keynesian in a nutshell says, use the open market, use the free trade, but there's places where the market just doesn't work. And the one thing that can happen is you can, so one of the things that he talked about, he came in right after the Great Depression. That was when he was at the height of his, and he believed that the government could and should step in where market economy fails, and also reduce the shock. So I think you're going to see an aggressive response once she's in. The direct payments at $1,200, I don't know if you'll see them continued. I don't know if they were personally as effective as they could have been, because they really did hit. I mean, there's actually, you can see that the upper middle class just held on to the money. I think we'll see the eviction moratorium continued, and mortgage forbearance probably as well. One thing is that most people probably don't know, and I didn't think of why $1,200 and why $600. Well, if you take 1,200 times 2 weeks times 40 hours a week, it's $15 an hour. So I think you'll see. So I think the other thing you're going to see is probably a federal unemployment comp trigger rate, so that we don't have to keep going back to Congress when the unemployment hits a certain rate. The Fed will trigger an additional payment. By the way, Dennis, we talked about this the other day, where unemployment comp came from. And if you're okay, I'd like to have you kind of explain that a little bit.
Yeah, actually, the state of Wisconsin was the innovator on unemployment compensation. It was part of the reforms that came out of the Fighting Bob La Follette period. It was in response to a big depression at the end of the 19th century. And Fighting Bob was elected at the beginning of the 20th century. And it was a way of compensating people who lost their jobs, probably temporarily through no fault of their own. They were laid off for the most part. And it was a way of helping them out. The target was primarily the kind of people that we had in Wisconsin, which were people working for various businesses. Once it got to the federal level, because people particularly in the Roosevelt administration with the New Deal, thought this was a good idea. Then it got kind of altered, one might say polluted, in a way that responded to political pressure. FDR had to rely on Southern Democrats for support for getting various policies adopted in the New Deal. And when it came to unemployment compensation, the Southern delegation in Congress insisted that this not go to people who were African American. So unemployment compensation did not cover domestic workers, did not cover farmers, and that was done primarily to put in their place, there in quotation marks, African Americans in the economy. That still is a feature of unemployment compensation. It doesn't cover all people who are getting paid for their wages or paid for what they do. Still doesn't cover domestic workers or most agricultural workers.
Dennis, was logging up in Necedah or Nina, where you're from, was logging one of the, I know it was certainly workers' comp because you lose your finger and your arm with logging, but was that also part of unemployment comp?
Yeah. Mm-hmm.
Logging stuff?
Yeah.
Yeah, workers' comp also started here.
Right.
For some
and that was, yeah, workers' comp is for people who couldn't work because of being injured on the job. And again, in both cases, both unemployment compensation and workers' compensation, if you are at fault, if you get fired or you were careless and didn't abide by safety rules, you didn't get compensated. And there is a big backlog, for example, in the state of Wisconsin, processing unemployment compensation claims. Sometimes there is for workers' comp too. And that's primarily over disputes as to whether or not somebody, number one, was covered, and number two, was it their fault that they lost their job or had to be laid off or whatever.
So
Okay.
why is there such a patchwork of unemployment? I know why the rates are low in certain states. It's so because it's a tax, and it's a way to attract businesses because it reduces the tax a business has to pay.
Kurt, on that, let me tell you, my nephew is down in works for Disney World, and he got laid off. He's a cook. He's a chef at one of their fancy places there with all of his training, and he got laid off. He still hasn't gone back to work. Florida, $217 a week. That's what it is. $200 a week, basically, for unemployment. That's it. And you said, Kurt, what? Because businesses want that, or it attracts business?
So it is actually a tax on business, right? A business pays in a rate, and it reduces as they don't lay people off. As you build up a fund.
Yeah, so that's referred to as an experience rate. For example, you take a look at Wisconsin's economy, the paper industry was notorious for years for not really having layoffs. That was a pretty steady employment. So their rate, the rate that the paper mills had to pay into the UC fund was pretty low. On the other hand, the auto industry was pretty high because they lay off people periodically, both in terms of the way that the economy is going and whether or not people are buying cars. But also there's the issue of sort of shutting down a factory partially or entirely in order to gear up for a different model, for a new model. And right now there's a big controversy in Wisconsin you may have heard of over whether or not employees have to wait a week after they're laid off in order to get their unemployment compensation. And the reason why that week is an issue is because for the auto industries, it takes them a week to gear up for a new car, a new vehicle. And they didn't want to have to be held responsible for paying their share of unemployment compensation based on that week that people were not working because they were changing the assembly line.
So Dennis, might we be at a point with this kind of economy and what's happening with it, that just like we had those, I would argue, seismic kind of changes in crisis times, is it possible that this is the kind of time where once we will have seismic changes like a universal single pay health or universal basic income that could come out of these kind of cosmic convergence of everything that's happening to us?
Well, certainly from a logical standpoint, meaning what is needed and what is the economy like, the gig economy. I mean, there are all sorts of things that have changed that you could really respond to. And I think that you can make a real good case from a policy standpoint. From a political standpoint, boy, that's something else. Unfortunately, one variable is the kind of partisan divide and the role that money plays in financing campaigns. And that kind of, so there's the political logic and there's the public policy logic. And I'm not sure they converge. Maybe they will at some point, but right now I'm not sure that they really do converge.
Well, and this may be more for you, Kurt, but there's questions here, but could we be doing better in terms of targeting who really gets the aid and how it's used?
I believe we could, yeah.
For example,
the first thing I mentioned there, the PPP program, they're talking about targeting smaller companies under 50. The biggest problem was as a company grows, they typically, so the last one was under 500 employees. And so they're really large PPP monies going out very quickly because those companies are more mature and they have a relationship with the bank. And they suck. They effectively sucked it dry initially. So they're talking about targeting 50 employees and below. And most of the companies that we work with, we do IT for other companies. Most of our companies that we worked with all got PPP loans because they were big enough, and they got them very quickly. And it took them because, quite frankly, why not? It's if you don't, your competitor does. You're actually at a disadvantage. That $300 additional unemployment per week, I think, is paid for by FEMA right now, isn't it, Dennis?
Yeah, that's right. Yep.
And that's running out in December 26th, I think, is the last.
So someone asked then, Kurt, is if people on this, this show right now with us, including people like me, my wife and I got $1,200 each, plus I'm still paying off some student loans for my kids. So I figured out the other day that I got almost $5,000 in this household over the last 10 months from this. And that was not 5,000 that I, desperately needed, but I will take it, like you're saying with it. So is the solution to some of this just, we should all just be spending a lot more money instead of saving it?
Yes is the short answer to that. That's what, but that's again, what we're seeing is a bifurcation of the economy, right? The lower or less pay, they're running out of cash, right? They're actually, and most folks that are doing a little bit better are holding on to it. So you're talking about your student loan as well, Carrie?
Yeah, and
yeah,
we can handle it because we've been handling it. But the thing I worry about with that is that once again you're going to get this elitism that, oh, good, you could afford to take out $100,000 in student loans, and now I'm going to forgive them for you. And I work at Subway, and I wanted to do it, but I couldn't get it, or I didn't think it was right to do it. And now so you've got this, or won't you have this sort of elitist charge again if you start forgiving things like student loans?
Yeah, I mean, I think so. Dennis, this is really your gig. And also the other interesting thing is, how are we going to get some of this stuff through the House if the House doesn't, or through the Senate if the Senate doesn't? It's going to be gridlock again, right?
Yeah,
And
no, that's right.
one thing I wanted to ask you, Dennis, is nationalized unemployment comp. That would make sense to me, to do it just across the board. Is that ever, why is every state, even though, so I know the rules were what they were, but why is it not done at a federal level? I mean, there is, but it's very limited.
Yeah, the federal level sends, the federal government has some basic, but very basic kinds of parameters and boundaries. Yeah, and those are they're primarily so that states are eligible for borrowing money from the federal government when their unemployment compensation funds dry up or get real low. And that's happened in Wisconsin and other states. The main reason for it being done on a state-by-state basis is rather than a federal basis is because of history. The Franklin Delano Roosevelt and the New Deal didn't want to take that on. They wanted to encourage it and facilitate it as much as possible, but not be responsible for it. And so they let it up to states. And that's why you get this patchwork that you were referring to earlier.
Yeah.
Not all economies are, for example, like Wisconsin's with paper mills and automobile plants. So for some states, what we do doesn't make any sense. The 1 week issue doesn't apply. So that's probably again going to continue. I mean, Terry's right. A lot of the stuff just begs for national solutions, for different kinds of approaches, for some major tweaking, if you will. But things are, unfortunately, right now at least, not always generated because of the logic of a public policy issue.
Kurt, you have a couple of questions here. One is your early graph showing these are jobs that are coming back. They're not new jobs, but there are new jobs that are out there because of what's going on, or at least expansive jobs of, whether it's groceries or delivery services, all those prime Amazon trucks out there, which, by the way, I don't understand why they don't have license plates. But there is going to be some growth, right?
Yeah, so it's again, that's where Keynesian economics comes in, is they should help. We should help with the shock of the change, right? There are new jobs. Actually, one of my friends he runs a employment business, right? That's what he finds people jobs, and he can't fill all the manufacturing jobs. So there's a shift from service sector to manufacturing, and there's opportunity, but again, some of them are just, but again, yeah. So you're talking about this. Sorry, guys, I'm making you sick. This graph, yeah.
Yeah, one of your first ones. Okay, the other question is another one that's out there is to talk more about what's happening with China. Biden is going to have to face what Trump has left with China, the trade, the tariffs, all that stuff. And you have alluded to we can do this as long as we are the major economy. We all know that China is well into cryptocurrency. They don't, you don't use a credit card in China. Everything is on the phone, and it's either was it Alibaba or WeChat or whatever their money is.
Both of them actually are pretty dominant. Yeah.
Right. Can you talk more about?
Yeah, good. That's a good question. I thought about doing something on cryptocurrency as well. So I mean, I can briefly explain the best way I can describe cryptocurrency is usually, first of all, people have to understand what it is. Typically, we use a bank in the middle, right? And that bank, I may not trust you. You may and you may not trust me, but we both trust this entity to keep a ledger and says, yeah, I've got this much money in the bank. You've got this, and you trust them that it's going to get paid. In a cryptocurrency world, it's peer to peer, and everybody's got a copy of the ledger. So that's the only, I mean, that's the biggest thing of how cryptocurrency works. So you can remove that central bank. And China actually has done that with the yuan. So the yuan right now is still so we pay, or WeChat, and Alibaba, Alipay, I don't even know what's called, Alipay or whatever. Those are still primarily, the transactions are primarily done just with the standard yuan, but the Chinese government has basically sanctioned a cryptocurrency, and it's an electronic version of the yuan.
And so the fact that they're doing all of these trades with countries all over the world, so they're inserting the yuan into everywhere from South Africa to Australia to Europe to everything else. And so the danger you see is that it could supplant the dollar, and then we can't just print money like we're doing now to get out of trouble.
Yeah, it'd be less demand for the US dollar. It's going to take a long time for that to happen. I don't see it happening anytime soon, but I could see it happening. We aren't where we no longer are the world's currency. But almost everything right now is traded in US dollars.
Somebody asked, could you walk one more time through the 7 times velocity? And again, I think the thing to point out here, as somebody else points out, is that is an average. So it's true that somebody might put their money under their mattress, but nonetheless, explain how it can get from me buying a cup of coffee. Well, I guess if it goes to Starbucks, it's already in someone's pocket who's a billionaire.
Potentially, yeah.
It only moves once.
Potentially. But the one graph that where velocity has dropped off so much, let me see if I can find it real quick. I mean, let's see if I can find it. There. Or just dropped. I mean, people are just holding on to cash. You see it happening. Starting to spend a little bit, but we're just holding on to it.
That's a huge drop from 2000.
Yep.
That's when you started your company, 2000.
Well, I just picked year 2000. I could go back further, and I'm
just thinking. Dennis, somebody wants to know whether or not we should have more CCC and WPAs, like under Roosevelt.
Well, that has been talked about, and we might see that under Biden and Harris. It certainly was a way of dealing with a lot of low-income people, people who are out of work, providing them with public sector employment. That also was responsible for getting trees planted, for dealing with various park projects and public works projects and the like. We've got a couple dormitories on campus at UW-Madison that were built during this period. There's an area in central Wisconsin that a lumber company had clear cut, and it was causing some real issues, and the CCC went up there and planted trees, and we now have that area forested. So there's a lot of legacy, a certain amount of romanticism, and it was dealing pretty effectively with particularly unemployed young people, high school graduates, that kind of age cohort. So it's there's a lot of talk about infrastructure, needing to upgrade eroding infrastructure. This is a model that might indeed be part of the problem or part of the solution.
You mean we might actually have infrastructure week?
We might.
Well, I think you're right. The romantic thing tied into that's interesting. How many parks do you go into, and there's that beautiful old park shelter?
Oh yeah.
Or a path. You go up to Devil's Lake, and you go up that path, and all of the work and stuff that went into all of that. And that my dad was cutting under trees. He's born in 1917, and he was cutting trees under power lines with the, I think the CCC at that point when he was, no jobs and things like that. So, so before we get out of here, we got a couple more questions. Kurt, one for you, I think. So what does all this mean for the real estate market?
Good question. So because I believe inflation has to happen, and is already happening in the real estate market, I don't see it tanking. I'm a little concerned about commercial real estate because I don't think people are going to go back to work in the same way. I really don't. I think there's going to be a lot more creative ways to employ people, which is at least in certain segments of the economy.
What was that company that built a brand new corporate headquarters and never went into it? Is that REI or
REI? I think, yeah, I think it's REI. I mean, I don't think my little company with about 70 employees. I don't think we're gonna go back in the same way. I don't think they'll ever go back.
So you're a tech company. Do you need to have that space for equipment or anything? I mean, everybody's working from home, but
no is the answer to that. No.
So how many square feet do you rent?
7,000, maybe 8,000.
You could literally be done with that as a company.
Yes, I think we would have a meeting space someplace, but I don't think we need it.
And so all those down East Washington and all those things that have retail on the bottom, those new buildings that have buildings on top, retail. What about retail in those areas?
Yeah, I don't know. It's a good question. I do think actually Wisconsin is going to fare well in this because if you can live anywhere, why not? I mean, we don't have fires, we don't have floods, we do have tornadoes, but I think Wisconsin's going to fare pretty well in this. People can work for a company on the West Coast and live here. I now have employees. I got somebody that's living in Ireland, and two in Colorado, 2 in Texas. It doesn't matter where they live anymore.
Well, listen, it's about the witching hour, and I think we've gotten through all of them but one question. And I want to thank you for doing that, Kurt. And people have been saying they really enjoyed it. It's informative and
yeah. Hopefully it was useful. I know I'm not the best speaker in the world, but hopefully that explains some stuff. I do think we had a rare opportunity. I think we had a rare opportunity to make some changes. And I don't know, Dennis, this is more political. You're right. I could tell you what, from an economic perspective, what should happen, but I can't tell you what's going to happen.
Well, to tie into that, the last question, I will leave it unanswered for 2 weeks, because in 2 weeks, we're going to have somebody on climate change. And the last question to ask, what about climate change effect on all of the things you talked about, Kurt, from housing to, people moving, migration, everything. And next week, in 2 weeks, you want to talk a little about who that is, Kurt, before we go?
I can try to explain it. Dennis, you met him as well. PhD candidate, and he's at Notre Dame. And his area of expertise and his interest is around climate change and the political realm of that, right? Dennis, we kind of talked to him about. I'll defer to you because this is really your class. We talked about things.
I'm impressed, and I'm really looking forward to our next session on climate change. One of the perspectives that he's going to be bringing is a kind of a global perspective, not just public policy and politics in the United States, but around the world, in Europe, and looking at what kinds of factors go into responding in a meaningful way to climate change kinds of issues. So it's going to be a very interesting and thought-provoking perspective, and it's not going to be as remote from possibility as it has been, because a lot of the policy issues are going to be possible in terms of the politics now.
And so we want to thank everybody who stayed on with this. We started out with 88 and we left with 86, and now people are starting to drop off. But it looks like the extra credit Plato might be a hit, Dennis and Kurt. So thanks. Dennis, if people want to see a tape of this, once again, where is this thing held once it's up in a couple of weeks?
Yeah, and actually it might even be up earlier. It is available by going to the Plato website and then look under past lectures. That's the tab you want to look at. Click on there and it'll give you a number of choices, one of them being this particular program, and some of the discussions that we had last fall are up there as well. And Kurt, thank you very much. You need to revise one thing, and that is the way you describe yourself. You need to start describing yourself as very effective, very thought-provoking, very clear.
Okay. Thanks, everybody. Bye-bye.
Yep. Bye now.
Okay. Oh,
Good.
So I'll send you a little description to use for the link on the website then.
Okay. Great. Thank you.
Thank you very much.
Yeah, and trying to figure out. We'll get this up as quickly as possible. I'm getting feedback. I'm not sure why.